Hello everyone. Let us see the fifth chapter of financial management second, that is mutual fund. Meaning, it is a pool of money collected from public to be invested to realize specific investment objective of the investor. It is a pool of money collected from the public. That means mutual fund collects fund from the various investors and it pulls together and it invests in various companies securities and it gives a better return to the investors. By that way it realizes the investors objective, that is to get a good return for their investment. Now there are huge number of companies in a market, so investors they face a difficulty in choosing companies to invest. So they have to predict the profitability of every company, so they have to analyze and understand the annual reports. This makes them to call for professional expertise, but an ordinary investor has no such expertise, and again money invested by the single person is too small to be diversified among different securities. So mutual fund fills the gap of investment expertise between investors fund and companies securities. Mutual funds have variety of schemes to suit the need of every type of investor, and it makes portfolio of investment. So let us see the formation and management. Every mutual fund of India is established under Indian Trust Act 1882. It should be registered with SEBI under SEBI Regulations Act 1996. The promoter of a mutual fund is called the sponsor. One who brings mutual fund into existence is called as the sponsor. Sponsor appoints board of trustees, board of directors. The board of trustees enters into relevant agreements with an asset management company and custodians. Mutual fund schemes begins with inviting the public to invest. Like every company, mutual fund schemes also begins with inviting public to invest. It invites the public to invest in the units of mutual fund. Then money is managed by the asset management company. So money which are raised from the public that are managed by the asset management company. That's why this AMC is called as fund manager of the mutual fund. So we'll see the parties to a mutual fund. First person, it is sponsor. Who is sponsor? The person who brings mutual fund into existence. Every mutual fund bears the name of a sponsor. You can see every mutual fund's name starts with sponsor's name. Example, Unit Trust of India sponsored mutual fund is called as UTI mutual fund. HDFC sponsored mutual fund is called as HDFC mutual fund. Canara Bank sponsored mutual fund is called as Can Bank mutual fund. Like that. Activities of a sponsor. First activity is to promote the mutual fund, bringing mutual fund into existence, starting mutual fund, promoting a mutual fund. Appointment of trustees, custodian and AMC. All these functionaries are appointed by the sponsor for the working of mutual fund. Then sponsors should have a track record of operating in financial market at least in the last 5 years. So sponsors should have a experience in operating in a financial market at least last 5 years. In the last 5 years he should have operated in a financial market. Then out of that 5 years track record he should have a profit in last 3 years. Out of last 5 years track record he should have made a profit at least in last 3 years. Capital contribution. Fund will be maintained by the fund manager called AMC. So that fund capital is contributed by the sponsor at least 40%. Out of the total capital, 40% should be contributed by the sponsor. Then second one is trustee or board of trustees. Sponsor appoints a board of trustees. A company registered under Companies Act can be appointed as a trustee. So that means a company which is registered under Companies Act as private limited company, can act as a board of trustee, or it can act as a trustee for the mutual fund. The trustee company or board of trustees should act according to the provisions of Indian Trust Act 1882, as it is a trustee for the mutual fund, even if it is registered under Companies Act as a private limited company, but it should follow the provisions of Indian Trust Act 1882. Trustee should protect the investors' interest. So policies framed by the trustees, or any decisions that are taken by the trustees, that should not affect the interest of the investors. All other functionaries like brokers, AMC, custodians are accountable to trustees. All these functionaries are appointed by the sponsor, but they are accountable to trustees, because trustee will supervise the functions of all these functionaries. He will see that all the work are done by these functionaries. Trustees supervise the activities of AMC. Third party is Asset Management Company, or AMC. It is known as a fund manager. It designs various schemes of mutual fund. It is called as a fund manager because it manages a fund of mutual fund. It designs variety of schemes for the mutual fund. It analyzes the corporate performance and buys and sells securities. It analyzes the corporate performance. That means it analyzes the performance of different companies, which is best to purchase its securities, and which is a right time to sell the securities. All these analysis will be done by the AMC. Features: an AMC is registered as a private limited company. Every AMC must be registered with SEBI. Again, it should be registered with SEBI also. The capital of the AMC is provided by the sponsor. Minimum 40% capital should be sponsored by the sponsor. Every AMC must have a net worth of rupees 10 crore at all times. So net worth, at least it should have a net worth of 10 crores. It cannot act as AMC of more than one mutual fund. AMC can act as a asset management company for only one mutual fund and not more than one. The AMC signs an investment management agreement with the trustees. AMCs are appointed by the sponsor, but they are accountable to trustees, so that they signs investment management agreement with the trustees. The AMC charges a fee for the investment management. For its service, it charges a certain amount of fees from the mutual fund. All investments, sale and purchase of securities are done by the AMC. Not directly, it makes it done through other functionaries, but it is controlled by the AMC. Sale, purchase of securities are done by the AMC through other functionaries. Custodian, that they are responsible for securities bought. They carry out the back office function of the mutual fund, where the securities are held in demat form. They ensure that securities bought are transferred to demat account. When the shares are sold, delivery instructions are issued by the custodian. Custodian also receives a dividend or interest on the mutual funds investment. Bonus issue, right issue, sale, buyback will be done by custodian as per the advice of AMC. Other functionaries: registrar and transfer agents. Throughout the life of the fund, purchase and sale of units by the fund are entered in the register, which are maintained by registrar and transfer agents. When the units are sold by the mutual fund to the public, the registrar and transfer agents open the register of unit holders. In that register, they are going to enter the sale and purchase of securities by mutual fund. Brokers. Brokers are appointed for purchase and sale securities by the AMC as a part of investment. Brokers are the members of recognized stock exchange holding SEBI registration. Selling agents and distributors. They are appointed as marketing agents or salesmen for the units of mutual fund. They popularize the units of the mutual fund, so they creates a demand for the units of the mutual fund. That's why they are called as marketing agents or salesmen for the units of mutual fund. Then bankers. Bank accounts are open to carry on the cash transactions of the mutual fund. They maintain current account and other accounts of the mutual fund. There are mainly receipts and payments every year made by the mutual fund through the bank accounts. So mutual fund need to open an account with the banker. In that account, through that account, all cash transactions are carried on. Legal advisors. Lawyers or advocates are employed to comply with the legal formalities. Any disputes or litigation arising may also be looked after by the legal advisors. Auditors. Like the auditor of any other firm who inspects the books of accounts maintained and transactions carried on, auditor of a mutual fund also audits the accounts and gives his report every year to the mutual fund. Next, types of mutual fund on the basis of structure. It is classified into three. First one is open-ended schemes. These are the schemes which do not have fixed maturity period. That means there is no locking period as such. Investor can enter at any point of time and exit at any point of time. They can invest and withdraw at any point of time. Selling agents and distributors are used for the sale of units to the investors. Example, SBI Magnum Equity Fund, UTI Master Plus 91. Second type is close-ended schemes. These schemes have a fixed maturity period, say 1 year, 2 year, 3 year, like that. There is fixed maturity period. After the initial offer, they won't buy or sell the units. Mutual fund will not sell or buy the units after the initial offer. If the investor, if they want to sell or if they want to purchase the units of mutual fund which are close-ended schemes, then they have to convert their units into demat form. Then they can exchange in a exchange platform, in a stock market they can purchase. For that purpose they have to convert their units into demat form. Example, LIC mutual fund, that is Dhanavarsha. Third type is interval schemes. Under these schemes, the units are listed on the stock exchanges. In addition, the mutual fund also sells and repurchases the units at net asset value based price. Example, UTI Master Share 1986. So next we'll see the benefits of mutual fund. First benefit is stability for small investors, or it is suitable for small investor. Investors with a moderate saving cannot directly invest in the stock market. This is because he is not in a position to diversify his investment, because investment by a single investor, it is too small to be diversified among different securities. Such a moderate savings can be invested in the units of mutual fund. Risk management. Many of the investors do not have professional competence to manage the risk. As mutual funds have professional managers, they are able to manage the risk through diversification and also through derivatives. Wholesale investment. Every mutual fund makes a huge investment in the chosen companies. This reduces the administrative cost to the company. Investors' education. While selling the units to the public through market agents, mutual funds convince the investors about the need for diversification. This is done orally and through brochures and catalogs. Investment research. For framing the investment strategy and picking stocks in the primary and secondary market, every mutual fund has a research team of its own. Liquidity of stock market. Mutual funds add volume to the stock market. They buy the stock in a large number. In a bear phase, they buy the stocks. In a bull phase, they sell these stocks and book the profit. Thus, they add liquidity to the stock market and also stability. Development of money market. Many mutual fund schemes, particularly liquid funds, invest mainly in money market instruments. This would go a long way in development of the money market. Savings mobilization. Through the selling and distribution agents, the mutual funds tap the savings in both urban and rural areas. This results in commendable savings mobilization in the country. Next, we'll see the demerits of mutual fund. Mutual funds are not free from drawbacks. They suffer from following drawbacks. First one, it is not good for large investors. Mutual funds are good for only small investors. They are not good for large investors who wish to have control over companies with their investment. Investor cannot attend meetings and participate in management of the company is a second demerit of mutual fund. An investor who invests in the shares of the company directly, he can participate and attend the meetings and management of the company, but an investor who invests his savings through mutual fund loses the right to attend the company's meetings and participate in the management of the company. Third, risk of capital loss. When the funds of the mutual funds are not carefully invested, there is a risk of capital loss for the investors. In fact, this is a problem faced by the holders of units of the mutual funds in India. Fourth one, depressed conditions in a stock market. The success of mutual funds to a large extent depends on the successful working of the secondary markets. If there are depressed conditions in the stock market as in India, the performance of mutual funds will not be good. Thank you.